Welcome to the Wealthworthy Podcast. I'm Trisha.
Hi, I'm Darian.
Thank you for joining us. This week we will be talking about stocks to watch this month and as you look to grow your portfolio. So with IPO season kind of being a big deal at this point, everyone is looking to bring their companies public. And so it's creating a lot of opportunity for investors, which can be good for instances where you're looking to find the next big company or you're looking to find the company that will give you a certain return, double-digit returns, right? So as we're looking through those options, I think that we just need to be aware of what the leaders of those companies are interested in pursuing over the next couple of years, as well as how soon will they be able to hit profitability. So really when these companies are able to be profitable, that's when you start to see huge interest in what they're doing, how they'll continue on, because it's shown that they've been able to scale, it's shown that they've been able to continue building their product lines. So just something to be mindful of as you're looking for your stock picks. Now, one of the things to be cautioned about is that a lot of companies are also seeing their stocks decline if they're already a big name that's reached, I don't want to say unreasonable, but unreasonable prices, right? If the market is currently pricing them way higher than their actual value or what they've been able to earn up to this point, then you start to see interest pivoted from one stock to the other. And especially now with all the IPO activity, a lot of people who've heavily invested in some of the big names that we're used to are pulling money out of those stocks so that they can buy into some of these IPOs. So you don't want to be caught holding the bag unless you are planning and sure that there's some probability, some high probability that the company is going to do well over the next couple of years. So IPOs that we've seen recently, like Snowflake, where it completely skyrocketed at the public entry point, right? Like you don't want to be the one holding that at this point where it could go down unless you feel like, oh yeah, in the next year or 5 years, it'll reach that valuation and you'll feel confident that you'll make money over the next 2 years with it even being that high. So there are a couple of plays that could be for you based on where it's priced now, and those include Lemonade, ZoomInfo, and Upwork. Right now, those are all in a moderate price that could lead to some higher valuation over the next couple of years. So I think that they may be good purchases for you to look into. For Lemonade, it IPO'd a couple of months ago. Now the price has come down significantly. So if you can get in at $50 or under $50, then that's a great entry point for you to see the company grow. They have been in the insurance space looking to disrupt how we currently do insurance, and they are continuously growing. They're a newer company, of course, and they've been expanding this week, actually, or last week they announced that they were expanding into France. So they have a good strategy on how they're going to continue to expand in the insurance space right now, doing renters and homeowner insurance as well as pet insurance. So it's an interesting one to look into, and definitely if you can get in within that $45 to $50 range, then that would be ideal. For ZoomInfo, they are a software as a service company, so it's one that's offering some sales insights to companies. And when companies are looking to brand themselves and looking to grow their sales, a sales software is an optimal way for them to do so. So ZoomInfo is positioned well to be able to take on that market. And with software, it's one of those things where their overhead cost is really based on just what their product line is and not necessarily them having to purchase a ton of physical products as you would for any kind of manufacturing consumer products type of company. So I think that alone kind of helps them to be in a space where they can be profitable sooner than some of the other companies. So definitely one that you should look into, and if you can get in there under $35 per share, then that would be ideal. So definitely one to look into. And then the last one that I'll share as something that might be a good investment now is Upwork. I think that they've been doing steadily well. They are one that's providing a link between companies who need like some kind of freelance work, or you need somebody to help out with the project pretty quickly. They've been able to provide resources for that market, right? And now that we're in a space where people are working from home and we're all trying to figure out what'll work best, a lot more people are going to turn to freelance work to help them get through just a number of different projects that they're looking to work on. So Upwork could be an easy one for you to get involved in and really see some growth over the next couple of years. Right now, they're not as big as their competitor Fiverr, but they have the potential to continue growing and matching, if not outgrowing, the pace of Fiverr in the next couple of years. So definitely one that you can look into. Right now, if you can get in at $15 or under, then I think it's a great entry point for you. And those are the three that I would say we can easily see some meaningful growth over the next couple of years. But like I said, only if you do plan to hold for 5 to 10 years. Like I wouldn't recommend you trying to dip in and out of those three because they still have some room to grow. Another way that I think that people have been investing, and when we talk about these IPOs, a lot of companies are choosing to go through SPACs, which are special purpose acquisition companies, as a means to IPO instead of going through the traditional route. So they're choosing to go public by merging with these shell companies. And the good part is that if you are interested in getting early, you're able to take advantage of a relatively low price. And so those could be easy ways for you to really see growth in whichever stock picks you are interested in. And a number of celebrities and well-known big players are starting their own SPACs. So there have been a number of them coming out and sharing the different companies that they are working on right now. But the EV space has to be one where people are most excited, but the risk there is huge. I think people are excited about Tesla, and then that pours into the EV market as a whole. But some of these are probably really risky for you to get in on, because like even when I look at the Tortoise acquisition, which goes under the ticker Shell, SHLL, they're expected to merge with Hyliion, and it's already up to $50 per share. But all of these SPACs start out at $10 per share. So if you were to get in pretty early on some of these, then you can see some good upside as the company continues to grow. But this one, like, they retrofit the engines for trucks so that they can be electric. So they take a regular gas or diesel fuel using truck and they retrofit the engines to make it electric. So if you think about companies that have huge fleets of trucks, and it's going to be expensive for them to buy an outright electric vehicle and switch over their whole fleet, they can do this instead. So, I mean, on the surface, it sounds like a good cost-efficient way for companies to get their trucks to be electric and take advantage of those benefits, right? Like cleaner energy, cleaner air, hopefully cheaper costs for them as we have more and more charging stations. So it could be good. They do have competitors that are private, at least one. So that's why I think, like, yeah, they could be doing really well, but to be at $50 already is pretty high. So there are some that are reasonably priced right now that you could get into that are in different spaces. One is Social Capital, ticker IPOB, and they're expected to merge with OpenDoor.com, and that's a real estate buy and sell company. So they list homes for you to buy, and if you're looking to sell your home, then you can sell through that OpenDoor website. And it sounds like a relatively simple concept, right? And they don't expect to be profitable until 2023. So it's definitely one that you have to buy and hold to see how they're able to continue scaling up. Right now, they're at about 20 states that they are doing business in. And if they're able to master some of the larger markets, because they're not currently in like LA or New York, that are pretty large, expensive markets, but they're in many other states and have been doing pretty well. Just being able to attract customers who want to buy and sell, but are looking to bypass some of the fees that are associated with the process, right? You don't need to go find an agent if you can just buy it yourself. So that could be a good one. Another one that I have been looking into is FinTech Acquisition, which is FTAC. They're expected to merge with Paya, which is helping companies with their payment processing options, right? So when I think of that, I think of something similar to what Square does. Obviously, Square has gone public in the past already, so they have done some growing, and we've seen some movement on how they are able to monetize and continue to grow their business, especially with Cash App. But when I think about Paya, their focus is still payment processing, so it could be lucrative. Like, they could continue to grow the business. They've been in existence for a while, so the merger hopefully would prove valuable for them to continue growing. And obviously, if you get in early, it's still close to $10 a share, probably around $10.50, right? Like, if you can get in on that and there's even moderate bump up on their share price, it could be meaningful to you. So with these specs, the one thing to just note is that you're putting your money into a possible merger. So it may take some time for the merger to be complete, which is why there's more excitement and activity when people are thinking that it will be final. So if they announce it, because when they initially put the specs out there, they don't tell you what company it is. But over time, once they find a company that they are willing to merge with, then they will announce what that company is. You'll see a bump up based on how the market feels about it. And then within a month or two, you'll see more action for them to close out that deal. And so it could be a lucrative way for you to get in on a company that's newly coming to the market. One that recently closed, as an example, is Utz. It was Collier Creek beforehand, and now they've completed the merger and they're operating under the ticker Utz, UTZ. So that's the chip company. They make all kinds of different snacks in that salty market. And like, it started out same way at the $10 mark. It's close to $18 now. But obviously that's chips, so it's not as it doesn't have as much growth in the investor mindset as your electric vehicle companies, right? So people think of it as salty snacks, okay, like they'll do well, they've been doing well, but you don't immediately think like, oh yeah, this is going to the moon. Like, it's pretty real steady business. So it's practically priced right now. I think it has great room to continue growing. And so it's one that if you were interested in, then it'd be a good pick for you to get some steady growth and a steady dividend. But all in all, as you're looking at these ideas, you really just want to be mindful of the risk that's associated with all of these. And the safer safer option is usually to go with an ETF because those capture a larger portion of a sector or a market, and so you have more coverage when it comes time to thinking about how your money is moving. Like if you're going to earn a huge return or not, like your return will probably be moderate based on the companies that are a part of that ETF. But I think those are great options, especially if you don't want to pay attention to how these companies individually are performing. So if you're like, you know what, that's nice, but I want to be hands off, then an ETF might be great for you. If you're willing to hold on some stocks for a couple of years and want to see some of these double-digit growth opportunities, then it may be good for you. So check out a couple of these and see if they're a good fit for your portfolio. All right, well, that's it for us this week. Thank you for joining us. Bye.